Good Tuesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, all the way from Philadelphia, the city of brotherly love, Dmitry Pargalanik. How you doing, D?
Good morning, Will. How are you?
Good. You want to start with a disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I at Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance.
All righty.
There's the disclaimer. I'm going to share my screen. If anyone is joining us for the first time, Will and I, we do these shows in the morning to help answer questions you may have about the, excuse me, Market Chameleon tools, data or analytics. If you want to ask your question live, we provide a link to Zoom. Click on that link. It takes you over to Zoom. Click on raise your hand. Once you get into Zoom, once we let you in, you could ask your question live and direct. If you prefer to ask your question by typing it in, you can do that on the live chat on YouTube. Will's watching and he'll read it back to me.
Perfect.
So while we're waiting for more people to join us and for questions to come in, what we'll do is take a look at the pre-market report. These are stocks trading pre-market hours, and we'll see if we could get some insights in a pre-market. Once we're done that, if we have questions, I'll take those questions. If we don't, I'll just continue on the same conversation we had yesterday with implied volatilities. And I think it was, if I recall, trying to run a model to measure historically if implied vols tended to overestimate realized vol. Okay, so pre-market report, these are stocks trading in a pre-market hours. We come down here, we have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. Down here, I see 51 stocks made our percentage gainers list, 51 on the decliners. So from that perspective, we look like just neutral at the open, mixed bag. If you guys look closely at the list, you'll see small cap stocks in there, ETFs, leverage products, anything really that is listed on a major US exchange. If it's trading at pre-market hours and it meets our thresholds, it can make this list. So we want to narrow down the list to a smaller group of stocks. And to do that, we could use the filters above. And I'm going to use this one here in ETF. And click on that. You get a drop-down menu. And you could see that, you could select from these ETFs. They're broad-based ETFs. They're sector ETFs. SPY. That's the top one. That's the broad-based S&P 500 ETF. When we click on that, the list below will get filtered by, stocks that are holdings in the SPY, which are the S&P 500 constituents. And we've got 8 stocks here that made our percentage gainers list, 3 on the decliners. So from this perspective, looks like a slightly bullish bias at the open. Nothing sticks out that much. I think Lowe's just reported earnings and they're down 1.3% after they reported, similar to kind of what Home Depot did.
Well, I mean, it is amazing because I guess, right up against the wall with this debt ceiling.
Yeah.
And I mean, you do hear some positive things, but the market, certainly the traders on Wall Street, are pricing it like it's a non-event, right?
Yeah, right now, I'm just looking at SPY as you're saying it, but
I mean, we have a long weekend coming up, and there's they have to get it through, they'd have to pass something. It's like really down to the wire.
Yeah, I think that the way they're pricing it is that they're definitely going to pass something, because the not doing it is so catastrophic that they must do it, right? They have to do it, that the chances that they won't act on it are too catastrophic. It's too, it will just the consequences almost aren't even measurable right now if that happens. So that they will do it, some kind of compromise, some kind of reach, that they'll extend it. So I don't think that it's impacting obviously the fear of that. But I do think that a lot of like the rally right now is coming from this chat GPT, because
in every earnings report, it's been mentioned multiple, like if you scan for it, it's been mentioned, thousands of times.
Yeah. And the more you use it, and the more you learn about it, for businesses, it will definitely increase productivity, because, now, I've been using it every day now, for lots, and I'm learning a lot from it. I'm learning faster about, other like tools out there, statistical program, all this stuff, things that I didn't know about. Your learning process is much better. You could do things quicker, more efficiently. And you could see that there are lots of processes out there, a lot that tend to be repetitive, that this could handle. It doesn't mean you'll need to put in the work and effort into doing it, but once you do it, that your the productivity will increase tremendously. With and when you think like chat GPT, it's like an algorithm, it's a formula, it's a model out there. That's what they were able to do. So
yeah, well, my favorite Tesla driver is on Laurent. I know he sent us an email. He's using it for numerous things. It's
yeah, a lot of people are starting to use it to tweak things. So and it's very easy to adapt. Usually technologies are out there, takes longer to learn, as they come out, longer to learn and see how to the benefits and learn the features and stuff. This one is much quicker than other technologies that we've seen come out, where you could start, and you guys probably see a lot of apps right now being created around AI. They're coming out almost every day. You're seeing a new app now coming out. So I think that the productivity gains will be tremendous, at least from just personal use. And that's creating higher valuations as well. You see it in the tech and just like overall, companies, if they're able to increase productivity, lower their costs, then people are giving them higher valuations. But I think that's where a lot of the enthusiasm is coming from right now. I think they were doing something like, they were talking about NVIDIA, like, it's already valuations, and it's like to the stratosphere. This is like, it's going to be approaching $1 trillion soon in market cap.
Yeah, well, all this use with any of these AIs, which has been around for a while, right? It's not something new, but it's been, ChatGPT has given it a taste to the public, right? Where it's not all internal, where there's something going on.
It was right. I think that they simplified it so much, for the user, that all of a sudden it was like the eureka moment, like, oh wow, like the simplification of that ChatGPT created was what actually like just started that entire boom. It's like Windows for the operating systems, like all of a sudden everything became simple, everything became much easier. You're typing in prompts and it's spitting out answers for you. So anybody, you don't need, there's no learning curve to that, right? Anybody could use it. So that was like the genius behind it.
Yeah, it's very, very, very interesting. And it's going to, it's moving so fast, right? We're 6 months in. and the things you read every day and the changes and, but
Yeah.
at the end of the day, picks and shovels, it's going to take a ton of processing, right?
Yeah. Yeah. It's going to take, yeah. Well, and they're trying to come up with solutions for that, right? So I'm sure there are going to be companies coming up with solutions from that. So let's see, no questions. I could continue on what we were talking about.
Yeah, continue.
So I think, when, and it was a good question. Well, how do we measure, the implied volatility versus realized volatility? And does implied volatility just tend to always overstate the actual volatility? And it also connects a little bit to other questions that I get that I'd like to address. Especially, we get people who are very new to financial trading and investment. We get like the intermediate, they've got like really advanced people out there. And so I'm going to start out with the common questions new people, a lot of people give is like, they'll say, well, tell me, I want to know where SPY will be tomorrow. Let's say, but I want to know the price tomorrow before it happens. You get that sometimes, where they think like you could just forecast in the exact price. And when we talk about, statistical valuations and valuation models in finance, you're not going to get exact precision, right? Models don't usually give you an exact precision of, this is exactly where the stock's going to be, or this is exactly what the stock is going to, it is worth. Because if you knew that, right, if you could exactly say what the prices of each stock will close tomorrow, you will be the richest person on the planet, right? Because then you figured out a way to make just riskless profits, and you could scale it as much as you want. But there's no way to do that. And what financial models do is try to build practical models, right? They're not looking for, you can't do exact precision. You're trying to create practical models where you have the smallest error between your prediction and the actual, observations. Okay. So that's what you could, and if I draw it out, maybe I'll draw it out. And I think we did it. I'll come back to like a regression. If you draw it out, it's going to be something like this. You're going to create a model that tries to say, based on some input, right? You're going to have say you have this input, here. I'm going to try to estimate what the price of this, right? So if we want to just say, if we want to try to predict, I think we're using like the price of Apple. What's Apple supposed to change today? Well, we could maybe use, the market. And if the market is going up this much, then Apple should go up that much. But we can't get it exactly, or there's no way to know exactly. So this model, it gives you a best fit. It says, based on historical data and stuff, this is where our best guesses. Think of it as an average, and your observations, could be like, distributed around it equally like this. And so you could see the actuals are going to be away from the average, right? Because you can't get it exactly on there, but the better your model, the closer they are to your estimates. So but you could see here that it's pricing it where you could decide, well, if my estimate is here, and the standard error is this much, if I see an observation out here, well, that might be, then you have to decide, is that justified or is it overvalued, right? If the observation is out here, then you have to decide, well, is it actually undervalued, or, does it deserve to be out there? What changed? So again, financial model, you think of it as, there's no exact precision to it, to this stuff, right? It's you're running an estimate based on where do you think your average is, the best average that has the least amount of error around it. And then you're observing the actual markets versus your statistical valuation or whatever model. And not all models will converge. So the things with models is that everybody can have, different inputs, clean their data differently, prepare their data differently, use different time frames, all this stuff. There's biases, there's imperfect information. So there's no perfect model to plug it in, where my model is going to have exactly the same projections as if somebody, sitting across, the country in a different, looking at maybe modeling the same stock, but he's doing something different. In his mind, there's different inputs and he's running different models, and there's no way for us to exactly come up with the same equation. What's happening is you're working on your model to come up with your best estimate of what you think, this value is. And there are different models. So in this situation, this is a model that's looking at something that we can observe today. And based on that observation, this is what we think this is priced today. There are other models that use lagging indicators to try to forecast something into the future, right? So it's like, well, I could try to say, well, if unemployment is going up today, then 6 months from now, GDP should be affected this way. Or if interest rates went up today by this much, then the housing market in 6 months will start going down by that much. Or, so these would be correlations with they call cross correlation, right? If you put a lag in it. And also, before I move on, some people, they'll say, well, I see a historical probability of 80%. So now I'm going to look going forward, and I expect that this is going to occur 8 out of 10 times. So if the historical probability is 80%, 80% of the time, let's say this stock goes up when this happens, So then they'll look at it and say, well, I want to see that it exactly happens 8 out of 10 times the next 10 times. So remember that, when we're looking at an independent, spin, let's say, 80%, it's not the same thing as saying that if I do something 10 times, then I want to see exactly 8 out of 10. So like, let's say you have a basketball shooter and he's 80% from the free throw. The probability of the basketball player getting 8 shots out of 10, right? Even though he's 80% free throw historically, the probability of him getting 8 shots, exactly 8 shots out of the next 10 is only 6%. All right. That's the probabilities, right? So you got to, make sure, you're using it right. Like, say coin flip, and people do this. A coin flip is is, and that's the other thing, a coin flip, we call it objective probability. Objective probability is everybody can agree that there's 50-50. There's only two outcomes, 50-50, heads or tails. What we're doing in finance is called subjective probabilities because, those probabilities, they're human touch, they're estimates, they're used based on our inputs. So people can disagree with it, right? On the coin flip, we all agree it's 50-50. There's only two outcomes. But 50-50 doesn't mean that if you flip the coin 10 times, you're going to get exactly 5 heads and 5 tails. Okay, that's not what it means. Because the probability of getting exactly 5 heads and 5 tails out of 10 flips is like 25% or less. All right. So keep that in mind. Yes, you have on a single flip, it's a 50-50. But that doesn't mean that if I do it 10 times, I'm going to get exactly 5 heads and 5 tails. Okay. That's not what it means. So some people, I feel like, get that part confused. Now let me go to, if there are no questions, I'm going to go to talk about realized volatility versus implied. And to measure, there's no exact way to measure that. And for the following reason, we talked about, well, what is implied volatility? Implied volatility is this derived value from option prices. And even the implied volatility that we derive from option prices can differ between people, because which options did you use? What were your assumptions in your model and so forth. So this is a derived value. Implied volatility is not something like a stock price that we could grab. It's an estimate created by, it's an output from a model. That's what it is. Implied volatility is an output from a model that takes in your inputs, right, and comes up with this implied volatility, right? So it's saying, based on all these inputs that you put in, this is implying that the stock will be move around, fluctuate by this volatility. All right. So on the one hand side, what is implied volatility? Because if you use 30-day options, it'll be different than 7-day options. If you use 7-day options, it'll be different than if you use the 1 day to expiration. And if you use the at the monies, it'll be different than if you use the out of the monies. So you're going to get different implied volatilities depending on what you're referencing. And then what about realized volatility? So realized volatility, that's also a measurement. So, like a stock price, we could say, okay, if it closed here, and then closed there, we could calculate the percentage move, right? So if it closed at 100 one day and closed the next day at 110, we could say it's 10%, right? So it moved up 10%. But that means we have to reference those numbers, right? Because I could reference different numbers and get a different percentage. And volatility, how do you measure it? Because you're measuring the fluctuation of the stock, right? So if you're measuring the fluctuation of the stock, it's not just the movement. You're trying to get the essence of, is it volatile? Is it moving around? But how do you measure that? You have to come up with an equation and a model to do that as well. And realized volatility could be different who you ask, right? So some people will say the realized volatility will be the close to close, right? So I'm going to measure we're closed to the next day we're closed, and to the next day they were closed, and then you put that in there, and that's your realized volatility. But other people will say, hey, but the market is open during regular trading hours and the stock's moving around, and it's moving around at different prices, and it could open at could close one day at 100 and the next day could close at 100 again, so it looks like zero volatility, no change. But in between, it could have fluctuated wildly, right? It could have gone up, opened at 110, sold down to $90 by midday, rallied back up to 100 at the close. So there's huge volatility in the stock itself. But if you just inputted the closing price from the previous day, 100, and the closing price the next day, 100, your equation tells you you have zero volatility, right? So all this stuff you have to bear in mind when we're trying to measure things, especially, things like volatility. There's no exact, because we could get different answers depending on our methodology, right? Depending on our methodology of trying to measure these volatility estimates, our estimates could be way off from each other because we're using different assumptions, right? And you could look at volatility using the open, high, low, close method, or you could just use the close to close, but you'll get, sometimes they're close, sometimes they could be very wide apart. And how do you trade the volatility too will depend on how much of the realized you could capture, right? So all these things, they're trying to create estimates, giving us insights and indications of what we think is going on, and how do we, the best way to measure things and to compare it given the data, right? And we could look at it from different angles. So there's no one angle, there's no one right formula. We could look at it from different angles. So having said that, here, this report here, this is looking at it from a different perspective than what we looked at yesterday. And it's looking from week to week. It says during the week, if I started the week and I took a snapshot of the options, and then the whole week, I tracked the options from the beginning to the end. And I did different methods of tracking it. So one is I could buy straddle. Let's do a straddle. So I'm selecting a straddle. It all converted to straddle. And there are three ways I could take a look at that straddle. I could just buy the straddle and hold it to Friday, right? And see what happens. So that would mean, I didn't hedge anything between the start of the week or end of the week. I just simply bought it and waited till Friday, and then wherever it is, it's either in the money, in the profit, or at a loss. Or I could hedge the initial delta and wait, or I could do daily rehedging, which is trying to trade the realized volatility of the stock using close to close. All right, so that would be a method using close to close prices. So at the end of the day, whatever my new delta is, I hedged it. The next day I hedged it again. So all of a sudden I'm trading the stock, and the stock is I'm trading that realized volatility. And the P&L will be the difference between the options and the realized volatility in the stock. So let's just take a look at Apple. And these are the three different methods in Apple in the last 12 weeks. And you could see that in each of these cases, so far in the last 12 weeks, so far, there are winners, but between 33% and 42% of the weeks, right? How did the returns compare to the three different strategies? Well, you could see that the one that actually traded realized volatility versus implied, that performed the best. It still lost, but out of all of these, it lost 11% versus 24% and 22%. So you could say these were 2 times worse. This was bad, but this one was even worse by 22% versus 11%. But the median return, we could compare that. So somewhere in there, we could open it up. There was probably a pretty good win somewhere that lifted the average. It's probably this one. Or this one here. Oh no, that one, this one, 85%. These are the standard deviations of the returns around the average. So it tells you how much standard deviation there is. So you could see that from week to week, it could, the returns are all over the place, right? It's a high standard deviation, but that's options trading. This tells you the worst return and best. And then this will just take the average return divided by the standard deviation to compare, those units, which we call a Sharp. We're over 9:30, so we didn't have any questions.
One question popped up. It was on the Zoom. I missed it. We can get to it tomorrow. It's just, and you've answered this a lot of times, so I know that the short answer, but maybe you want to talk about it tomorrow. Sharus was asking, what is your take on taking profits on credit put spreads? Is it good to close trades at 50% profits or wait to expiration? So maybe that's something we can talk about tomorrow. Awesome job, D, as always, my friend.
All right. Thanks, everyone, for joining. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.
Yeah, remember, thumbs up. Always appreciated. Great job, D. Great job, Chameleons, for joining the show. Thanks, everyone. Have a great day.